Hello, and welcome to our November edition of our Reg Brief. This is the spooky edition where we will cover the important regulatory developments that happened during the month of October. I'm Cheryl Brazard, and with me today are Jenna Dean and Peter Groh. First, we're going to talk about issues affecting the industry as a whole. Then we will narrow it down to depository institutions and issues affecting everyone else. This month was full of spooky events, and we've got a lot to cover. So with that, Jenna, do you want to kick us off with an update on the CFPB's 1071 and where it stands right now?
Absolutely. Since we had last talked about 1071, there has been a lot going on. I've broken it down chronologically because there is just so much. But first, we have the Supreme Court hearing oral arguments at the beginning of the month on the CFPB's constitutionality. So the plaintiffs in that case argued that the CFPB's funding structure violated the appropriations clause because it allowed the agency to self-determine how much they needed. And the plaintiffs also said that it's an illusory cap so high that they almost come close to never hitting it, and added that it's a unification of the sword and purse that's contrary to the intent of the framers. And the CFPB hit back and argued that the text of the appropriations clause doesn't limit Congress's authority to determine the specificity, the duration, or the source of appropriations, and that their funding mechanism is consistent with constitutional text, history, and precedent. And I will say some of the judges weren't impressed by the plaintiff's characterization of the CFPB's funding cap as so high it's almost not irrelevant. Justice Kagan said that $600 million is essentially a rounding error in the federal budget. So I think it's safe to say that she was not impressed or swayed by that argument. And the court in that case is going to issue their decision by June of 2024, but that is not it. We also have the Senate voting 53-44 to approve a resolution of disapproval to overturn 1071. And the members that brought that expressed concerns about privacy and the cumbersome nature of the information that institutions would have to report. And the resolution was backed by the American Bankers Association, and it had a twin in the House, and it was passed by the committee. But I would not get too excited. I have a feeling that President Biden would veto this if it landed on his desk. But that is not all. We have the third and biggest update that the U.S. District Court for the Southern District of Texas has ordered a nationwide injunction against the implementation and enforcement of 1071 for all financial institutions that are covered under the final rule. So the court in that case discussed precedent from the Fifth Circuit that stated two justifications for a nationwide injunction. First, being a constitutional command for uniform laws, and the second, a concern that patchwork ruling would undermine an injunction that's limited to certain jurisdictions. And so the court stated that although there's no constitutional command for uniformity, there is a statutory command for uniform laws with constitutional implications. And they added that the rule's sole purpose is to avoid disparate outcomes and to have equal application of lending laws to credit applicants. So there presumes to be equal application required to the financial institutions absent an exemption. And there is no exemption. So with this court order, the implementation and enforcement of 1071 is delayed for all financial institutions covered under the rule until the Supreme Court determines the constitutionality of the CFPB's funding structure, which again is June 2024. But I will say, even with the delay, it doesn't seem like institutions are slowing down their implementation process. So be sure to talk with your teams to make sure that you are on track with your business plan. Back to you, Cheryl.
Awesome. Thank you, Jenna, for that update. It is definitely easier and helpful to hear the breakdown because it helps us see exactly where everything stands as of right now. Speaking of the CFPB, they've been pretty busy this month. Pete, I think you have some information to tell us about a most recent proposed rule from the CFPB regarding personal data financial rights.
Right. It's been a long time coming, but it's finally here. And actually, as of today, it's officially published in the Federal Register. This has been related to Section 1033 of Dodd-Frank that was promulgated a decade ago. But the CFPB is seeking public comments to actually implement provisions of that section and decide on issues of regular access, use, and the security of our personal financial data. This is going to be a pretty big deal because it directs how all financial institutions are going to have to address these issues and deal with them as they evolve going forward. The first key element of the proposal is security. With cyber threats on the rise, the CFPB wants to ensure that financial institutions across the board to protect consumer data. And that means that the old practice of screen scraping will finally have to be put to bed. This could create stricter requirements for encryption, regular use of requiring multi-factor authentication, or extra security. Most importantly, the CFPB is supporting the transition from the use of things like screen scraping to standardized use of tools like APIs for that same transaction. Another crucial element of the proposal is data portability. The rulemaking is trying to make it easier for consumers to move their financial data from one service provider to another. Think changing your playlist from Spotify to Apple Music, but for your bank account information. This is a cornerstone of the open banking movement that the rulemaking is trying to support and foster, but the CFPB has been paying attention to since back in 2017 when it initially issued its draft guidance. Lastly, the rulemaking tries to address issues of access. This is about who gets to see that financial data and under what circumstances. For example, should third-party apps have that same level of access to a customer's personal financial data as your institution does? The CFPB is looking to define clearer boundaries here, but there's still some outstanding fuzziness about how the liabilities associated with those issues will actually come down. And that's something we'll definitely want to keep an eye on. For financial institutions directly, this is a little ding of an alarm bell that's had the snooze button running for more than 10 years. There's our recent institutional and industry pushback on the limited uses of data, hindering any further development of products or services in the financial sector. But I don't think that sky is falling anytime soon. The rulemaking is still under comment periods, so you'll still have some time before compliance is necessary, but you'll want to start preparing regardless. Even with a pretty generous 4-tiered implementation schedule that's starting with the largest institutions over 500 million, that's 6 months out from the final publication date. Smaller institutions will have as long as 4 years after final publication, but that doesn't mean it's not worth beginning now. That being said, the comment dates are currently slated to end December 29th, and there's an outstanding industry petition to hopefully extend that comment date a bit further due to the holidays. That notwithstanding, this is going to be something to prepare for, even if it's going to take a lot of time to roll out, determine the firm parameters of, or decide the implementation tiers beyond what they've already provided.
Awesome. Well, thank you, Pete, for providing that very thorough update. So now we're going to shift away from the CFPB just for a minute and talk about some recent FinCEN news and developments from the FRB. FinCEN issued a proposed rule that will require financial institutions to implement certain record-keeping and reporting requirements involving convertible virtual currency. FinCEN will be using its power under the Patriot Act for the first time to implement a special measure because it relates to matters involving money laundering. Now, what is convertible virtual currency, or CVC? CVC is a type of virtual currency that's equivalent to traditional fiat currency like the US dollar. CVC mixing is a way of handling CVC transactions in a way that hides where the money comes from, where it goes, and how much is involved. FinCEN pointed out that CVC can be used for legitimate and innovative purposes, such as enhancing privacy for those wishing to conduct lawful transactions anonymously. However, the proposal also discusses the potential risks involved. The proposal mentions that because CVC mixing is intended to make transactions untraceable and anonymous, it's also difficult for authorities to track these transactions. Therefore, these transactions are often used by criminals and foreign threats to cover up illegal money activities like money laundering. Vincent also points out in the proposed rule that CBC mixing allows cyber threat actors carrying out ransomware attacks to launder their CBC and convert it into fiat currency, minimizing the risk of being detected by financial institutions and authorities. So under the proposed rule, some of the information FinCEN is proposing to collect is the amount of any CBC transferred in both CBC and its US dollar equivalent, the CBC type, the CBC mixer used if it's known, the CBC wallet associated with the customer, the date of the transaction, any IP addresses and timestamps associated with the transactions, and a description of activity observed by the financial institution, including a summary of any investigations it may conduct. Now, it's important to also note that financial institutions will continue to have the obligations to file a SAR when warranted, regardless of whether the financial institution is also filing a report under the proposed rule. So if you're interested in commenting, you'll have until January 22nd of next year to do so. And in other FinCEN news, FinCEN has issued an alert to help financial institutions spot and report any suspicious financial activities that might be funding the terrorist organization Hamas. Now, we've probably all heard by now about the attack on the people of Israel that killed many innocent people. The attack was funded by Hamas's terrorist finance network. FinCEN reported that Hamas moves funds by smuggling physical currency using, among other things, money transmitters and Hezbollah-affiliated banks. FinCEN advises financial institutions to identify and report any suspicious transactions associated with Hamas financing as quickly as possible. The U.S. Treasury has also gotten involved, and they are taking steps necessary to prevent Hamas from raising any funds worldwide. To better assist financial institutions, FinCEN has identified some red flag indicators in their alert to help detect, prevent, and report potential suspicious activity related to Hamas's terrorist financing. And they have also included within the alert a special terms that they want financial institutions to use during any SAR filings to indicate that the suspicious activity actually being reported is in connection with this alert. So be sure to review that alert for that important information. All right, now let's shift to a development from the FRB. Every month, it seems that we are reporting about an enforcement action. And of course, this month is no different. And this case involves a bank out of New York that was fined for violating customer identification rules and for having deficient third-party risk management practices relating to the bank's issuance of prepaid cards. Now, what was happening in this case, the FRB determined that the bank failed to properly determine that, or to properly identify the true identities of applicants when opening pre-card accounts through a third-party program manager back in 2020. The FRB said that illicit actors use these accounts to collect unlawfully obtained state unemployment benefits. And as a result, the FRB is now requiring this bank to enhance its programs for customer identification, customer due diligence, and for managing risk associated with third parties. The New York Department of Financial Institutions also imposed a similar action against this same bank, resulting in penalties that exceeded about $30 million. So this case can serve as a reminder to make sure that your customer identification procedures are in line with BSA requirements and that you review your existing customer due diligence practices to ensure they accurately assess your customer risk. And of course, you want to make sure that you are evaluating and updating your risk management strategies and processes related to third parties. All right, so let's shift back to the CFPB for a minute. Pete, I believe you have some news about a recent joint statement involving fair lending that included the CFPB.
That's right. I promise the CFPB is not the only agency I'm going to talk about on this podcast. That being said, the CFPB, with Department of Justice and a couple of other federal agencies, clarifying that discrimination against non-citizen borrowers in credit transactions is considered prohibited under the Equal Credit Opportunity Act. On the definition of the term non-citizen borrowers, this applies to individuals who are not U.S. citizens but are legally residing in the country. This could include permanent residents, but also includes visa holders and even some undocumented immigrants. The joint statement was trying to make clear that these individuals should not be discriminated against when seeking credit. Secondly, the statement instructs financial institutions, banks, credit unions, and other lenders that they have to ensure that any lending policies that they have don't discriminate based on nationality, national status, or nationalization status, or immigration status. This includes not only the underwriting process, but also the terms and conditions under which those forms of credit are offered. That should be transactions, including your car loans, your home loans, or consumer credit like credit cards. Thirdly, the statement tries to provide some guidance on compliance and documentation of that compliance. Financial institutions are encouraged to review their existing policies and procedures to ensure that they're in line with the code. This might require some additional changes to underwriting guidelines or additional staff training, but could also include changes to algorithms or technology that's been used in automated decision systems that may be triggered based on immigration status. So, what does this mean first for non-citizen borrowers? The immediate impact is increased access to credit. Non-citizens should now find it easier to secure credit on fair terms. That's a significant step for financial inclusion that could have some significant long-term benefits. Things like improved credit, serving the community, and the community itself. Admittedly, it comes with a couple drawbacks. It requires a comprehensive review of your existing policies to ensure that you're in compliance with terms of the code. This might incur some additional costs in the short term and will definitely require some additional training, but the long-term benefits of market access and serving a more diverse customer probably obviously outweigh these costs. Institutions will need to be vigilant in ensuring that they're compliant with new guidance, but that being said, the CFPB and other regulators are going to increase their scrutiny on this issue in the future, so any money spent there will be well spent. Now, for professionals in the financial industry, this is another wake-up call. Compliance officers, risk managers, customer service representatives, anyone that so much as touches issues of consumer credit will have to be trained on the nuances of this new guidance. I think the key takeaway here is that the joint statement comes with risks and costs, but ultimately, is a great step forward. It takes part of an initiative that CFPB has been participating in to make sure they're hearing more from immigrant voices and non-citizens that have had issues with access to credit in the past. So this might not be the last that we hear on this issue.
Awesome. Thank you, Peter. Well, this definitely does remain a hot topic, and we'll continue to follow these types of issues. Well, speaking of hot topics, we have another one that's frequently discussed in the news, and we've discussed it here in our regulatory briefs almost every month, and it has to do with redlining. Jenna, do you want to bring us up to speed on the recent enforcement actions from the DOJ and the CFPB?
Absolutely. I actually have a couple scary stories regarding fair lending here this month. First, we have the DOJ securing yet another settlement for redlining. The DOJ announced a $9 million agreement with Ameris Bank to resolve allegations that the company had engaged in a pattern or practice of redlining predominantly Black and Hispanic neighborhoods in Jacksonville, Florida. And the allegations state that from 2016 to 2021, Ameris had avoided providing mortgage services in majority Black or Hispanic neighborhoods in the city, and they had also discouraged individuals seeking credit from obtaining home loans. Also, they operated 18 branches in Jacksonville, but had never opened a branch in a majority Black or Hispanic neighborhood in the city. So this is something we've seen a lot. You can't do that. And the DOJ said, no, you're going to open a branch in a majority Black or Hispanic neighborhood in the city. You're going to donate $7 million into a loan subsidy fund to help communities of color who have been affected by lending discrimination. And you're going to employ a full-time director of community lending to oversee the continued development of lending in those communities. And this is just a continuation of the DOJ's work. This is now $107 million that the Combating Redlining Initiative has brought in to help communities of color who have faced lending discrimination. And that's not the only scary story. We have the CFPB filing another lawsuit against Freedom Mortgage Corporation for providing false information to federal regulators. And if this sounds familiar, it's because it probably is. In 2019, the CFPB had found that Freedom Mortgage Corporation had intentionally misreported HMDA data regarding applicants' race and ethnicity, and they were fined $1.75 million and told, you need to improve your compliance management system. And they did not improve it enough, because here we are again, and the CFPB found that their 2020 HMDA data was riddled with errors across multiple data fields. And on top of that, since they were under an order for their 2019 enforcement action, they are now in violation of that 2019 order. So the CFPB filed a lawsuit to stop Freedom Mortgage Corporation's alleged unlawful conduct, and they're going to seek that they pay another civil monetary penalty to be put into the CFPB's Victim Relief Fund.
Wow, a lot going on in this space. So continue to stay tuned. Thank you, Jenna, for that update. Now let's shift the discussion a little bit to climate risk. Pete, tell us what's happening in this space.
So earlier this month, the Fed released some principles for climate-related finance targeted at large financial institutions. But first off, let's break down what we mean by large, which here we're talking about 100 billion in assets or more, and then what those principles are. The Fed broke it out into 4 categories. They've given it in governance, strategy, risk management, and disclosure. So we'll start with governance. The first principle tries to emphasize the role of financial institutions' board and senior management in overseeing climate-related financial risks. They're trying to illustrate that this shouldn't be a sideline issue. It's a governance concern that requires top-level attention consistently and seriously. Second, strategy. The second principle focuses on the integration of that top-level thinking into the business strategy and evaluation of climate-related financial risks relevant to the overall institution. This means not just assessing risks as they are currently, but planning for future scenarios. The kind of scenarios that might include regulatory changes or increased physical risks like an extreme weather event or a really rough hurricane season. Risk management is the third principle. This third principle is about identifying, measuring, and managing the climate financial risks that are evaluated or seen. This could involve anything from the data collection stage to scenario analyses. FIs are encouraged to develop metrics and tools that they can use to quantify those risks. And last is disclosure. The last principle calls for increased transparency. And institutions should disclose their climate-related financial risks in a way that's useful not only for the stakeholders that include investors and regulators, but also hopefully members of the public. So what does this mean for those large entities? First and foremost, they need to start taking climate-related financial change seriously, even if they weren't already. The principles provide a kind of roadmap or guidelines on how to approach those risks, from the board level governance to day-to-day risk management. For the broader industry as a whole, smaller institutions or related service providers that serve these larger FIs, the principles set a new standard, one that might become a floor in the future. They're a signal that's intended to influence not just banks and the large federal credit union, for example, but also asset managers, insurance companies, and other financial entities. However, there's a related development at the state level that I think bears discussion that might have a little bit more teeth on it. California recently enacted a pair of pieces of legislation. One, evaluation of climate-related financial risks, Senate Bill 261, and two, the Climate Corporate Data Accountability Act, Senate Bill 253. Each of these require entities with revenue over $500 million and $1 billion annually, respectively, to report and verify the financial risks, and the content of the corporate greenhouse gas emissions, not just downstream, but also upstream. This state law and its greenhouse gas reporting cousin both aim to address similar climate-related financial risks that the Fed is talking about, but by requiring certain financial institutions to conduct these climate risk scenario analyses and disclose the results. The reason this is a big move is because California is a major financial hub, but also because it has a larger economy than India or England, and mostly because it often sets the tone for other states here in the US, even if they don't like each other very much. So how does this state law in the Golden State compare to the Federal Reserve's principles for all 50? First is scope. While the Fed's principles are aimed at large financial institutions, these two Senate bills, and specifically Senate Bill 261, has a little bit of a broader reach. It's trying to affect not just banks, but also insurance companies and pensions that are operating in California. Second is the idea of an actual statutory law enforce the Fed's pirate code. Here we have a law with enforcement provisions, penalties, and things that will be shook out as time goes on. The Fed is a little bit more fuzzy in terms of how the metrics that they create will be evaluated, but the statutes Californians given and said, this is how you'll decide, this is how you calculate, and this is how you document those risks. All it is to say that for FIs that are currently operating in California, they will need to invest in things like data analytics, more scenario analysis tools, and possibly even third-party assessments to meet the law's mandates. It requires an independent special certification, so simply saying this is what we have is not going to suffice in the short future. If other states also follow California's lead, we could see a patchwork of state-level regulations, and financial institutions will have to take that into account when they're deciding what communities to service and how to service them. But hopefully on the upside, it could also potentially drive faster action on the evaluation of those climate-related financial risks. So we'll see.
Awesome. Great breakdown, Pete. Thank you. Well, I'm going to shift the focus back to the CFPB and talk about another popular topic, which is junk fees. CFPB issued a recent advisory opinion regarding Section 1034C of the Consumer Financial Protection Act, which prohibits large banks and credit unions with more than $10 billion in assets from imposing what they call unreasonable obstacles on customers, such as charging excessive fees for providing basic information about their accounts. CFPB stated that many large financial institutions are shifting away from the banking model that used to prioritize customer service, and clarified in the advisory opinion that people are entitled to get the basic information they need without having to pay these junk fees. So if you're a large financial institution, a couple of key takeaways from this advisory opinion could be to take a look at any fees your institution charges currently to try to determine if under the advisory opinion, they would be viewed as junk fees. If you do charge fees for customers to receive certain information about their accounts, review and update your policies and procedures to see if any of these fees that you're charging for customer information requests, make sure they're not unreasonably interfering with the consumer's ability to exercise their rights to receive this information that's entitled to them under the Consumer Financial Protection Act. Shifting a little bit to a report that was released by the CFPB, they conducted a study about non-sufficient fees or NSF fees. In the report, they show the results of the study where the CFPB analyzed a large financial institution that have made the decision to eliminate non-sufficient fees. The study found that 2/3 of banks with over $10 billion in assets had eliminated NSF fees altogether, and that 16 out of the 20 credit unions with over $10 billion in assets have continued charging NSF fees. So take with that with what you will and just have these considerations. The report has a breakdown of all of the financial institutions and which ones are continuing to charge those fees. So you want to consider that if you are still charging those non-sufficient fees. All right. Well, we have more important news coming up about the Community Reinvestment Act. Jenna, what's going on with the CRA?
Yeah, we have almost mummified during the wait, but the FDIC, the OCC, and the FRB have met, they have voted, and they have approved the draft final rule for modernizing the Community Reinvestment Act. So the agencies have pointed out a couple things about the rule, including that the final rule includes tailored performance standards based on banks' size, business model, and local conditions. They also update asset size thresholds for small, intermediate, and large banks. So now small banks are those with 600 million or less in assets. Intermediate banks are those with 600 million to 2 billion in assets. And large banks are those with 2 billion or more in assets. And that is going to be adjusted annually for inflation. The final rule also reduces the number of major product lines that are going to be evaluated under the new retail lending test from 6 to 3. So those are now closed-end home mortgage loans, small business loans, and small farm loans. The rule also exempts out small and intermediate banks from new data collection requirements that are specific to only large banks. So those institutions with 2 billion or more in assets. And it also provides that small banks can continue to be evaluated under the existing framework with an option to be evaluated under the new framework. And lastly, and most importantly, what many people requested, that the rule increases the amount of time that banks have to come into compliance once the final rule is adopted. So it used to be 12 months or 1 year, and now banks will have 24 months or 2 years after the rule's adoption to come into compliance. So the April 1st, 2024 effective date is applicable to provisions of the final rule that have current similar CRA regulations, such as facility-based assessment area delineations, the effect of CRA on applications, and CRA examination schedule public notice provisions, along with new public engagement provisions. And then January 1st of 2026, banks will be required to comply with all of the other provisions of the final rule, except for certain reporting requirements, which come into effect 1 year later at January 1st of 2027.
All right. Thank you, Jenna. I think many of us doubted that we would see these rules finalized this year, but we did. All right, well, let's move on to our final topic for the day, and this issue is affecting credit unions. NCUA issued a proposed rule looking to simplify their share insurance regulation by establishing a new category for trust accounts. Now, this category would provide share insurance fund coverage for funds that are both revocable and irrevocable trusts deposited at federally insured credit unions. It would also provide consistent share insurance treatment for all mortgage servicing account balances that are held to satisfy principal and interest obligations to a lender. And it would offer flexibility in record-keeping requirements that would allow NCUA to look to records that are maintained by parties other than federally insured credit unions and their members. Well, I told you at the outset that we had a lot of things to cover, and that we did. That will do it for this month's Reg Brief. We promised you that it would be packed with lots of updates. Please join us for next month's Reg Brief, where we will fill you in on all of the events that affect the industry for the month of November. Continue to stay plugged into Ncontracts and our InComply software for more compliance updates. Goodbye for now.